Global markets have yet to open after the overthrow of Bashar al-Assad's regime in Syria, which may further destabilise the Middle East. The Fed is seen on track to cut again next week, and the RBA is expected to hold tomorrow. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ senior China strategist Zhaopeng Xing explains why he's watching for a potential GDP target downgrade out of China's annual Central Economic Work Conference this week.
There will be millions of job loss if Trump add China tariff. I think all these challenges will let the authority to rethink the GDP target. We call that the GDP target may be downgraded.
But first, in 5 and 5 with ANZ, markets have yet to open to react to the overthrow of President Bashar al-Assad's regime in Syria, with the focus instead on Friday night on US non-farm payrolls. Jobs growth in November of 217,000 was broadly in line with expectations, but the unemployment rate rose 0.1% to 4.2%. Here's ANZ economist Bansi Madhavani in London.
This is the highest since summer in the Northern Hemisphere, and it's near levels that prompted the FOMC to start cutting cycle with a 50 basis point rate cut earlier in the year. So our view is that the labour market report keeps the Fed on track to cut rates later this month, and we continue to see 25 basis point cut at the FOMC's December meeting. Currently, markets are pricing about 87-88% chances of a 25 basis point rate cut at the Fed's upcoming meeting.
Number 2. The Reserve Bank of Australia makes its final rates decision of the year tomorrow. ANZ's Group Chief Economist Richard Yetzinger expects no change.
The probability of a tightening is much, much lower than the probability of an easing, and the probability of an easing is very low. So we're not going to see anything on the interest rate side. What they say, of course, will be important. Do they continue this creeping shift away from the elements of hawkishness that they've previously been talking to or not? And also, there's 3 speeches slated for the week, and they all come after the Reserve Bank decision. So if the bank feels they need to maybe correct any interpretations of the statement in the early part of the week, they'll have ample opportunity to do that. And employment numbers as well out this week. We think the numbers will continue to suggest that there's sufficient job growth in the economy for the bank to stay on hold for the meantime.
Number 3. ANZ senior China strategist Zhaopeng Xing is also looking out for China's CPI and PPI inflation figures for November out later today. He sees both figures being flat in an economy beset by deflationary pressures. A quick change is unlikely, he says.
China will take some years to resolve this problem because the biggest reason behind the deflation is the supply-demand imbalance. Currently, China rely on exports to mitigate the deflation risk, but I don't think it's a reasonable way. In the next few years, China will have to boost the domestic demand.
Number 4. The Reserve Bank of India left its official cash rate on hold on Friday night, dashing market hopes for a cut. But the central bank did ease the reserve requirement ratio for banks by 50 basis points, which ANZ India economist Diraj Nim says will allow banks to pump extra cash into the economy. And he says don't give up on a rate cut yet.
The outlook is that the Reserve Bank of India has not denied a rate cut. In fact, the governor went on to say that if growth slowdown lingers, it will warrant policy support, which we read as that the February meeting is live for a rate cut, and that is when we now expect the first rate cut to happen.
Number 5. Vietnam's annual inflation rate fell in November to 2.77% from 2.89% in October, which was softer than market expectations. ANZ FX analyst Kosani Basak says lower food price inflation and a fall in transport prices were the driving factors.
The lower inflation number will allow the State Bank of Vietnam to follow a more accommodative monetary policy to stimulate domestic consumption and credit growth, especially when Vietnam's export momentum is showing signs of slowing.
Kosani Basak there. Now, in our bonus deep dive interview, ANZ senior China strategist Zhaopeng Xing will be watching the communique to come out of the annual Central Economic Work Conference this week, which is after a key Politburo meeting. The big focus is on whether China will lower its growth target of 5% for 2025.
In recent days, Xinhua News Agency and the People's Daily reported a lot of things on China economy. Most famous one was the day before yesterday, saying that less than 5% GDP growth rate will be acceptable. I think this is a signal to downplay the GDP target. This year, in the first 3 quarters, China GDP only grew about 4.8%. It's very likely that the final number below 5%. So I think this report report also us some room to be more tolerant about the low GDP growth rate. For next year GDP target, I think this report also signal that the GDP target may be downgraded. 2024 we have 5%. I think next year 2025 the GDP target may be less than 5%.
And how might the authorities view employment over headline growth next year?
We maintain our view that the employment situation is much important than real GDP growth, because at this moment, China will have some very big challenges next year. The first one is the 12.2 million graduates in 2025. This is the new high in the history. Another one is there will be millions of job loss if Trump add China tariff. I think all these challenges will let the authority to rethink the GDP target. We called that the GDP target may be downgraded, but I think the authorities will upgrade the employment target. In 2024, the employment target was 12 million. I think 2025, I think the authority will have to set at least 13 million to accommodate the graduates and the job loss from factories in the next year.
Yes, in your note this week, you've talked about the prospect of tariffs, maybe not the 60% that Trump has talked about, but maybe closer to 30%. How might China respond to that, and who might benefit after the China response?
Okay, from the policymakers' perspective, I expect China will rely on domestic demand to offset the tariff shock. Another way to offset the tariff shock is to increase the export control to the US. This is another way of retaliation. Except that I don't expect China will let the renminbi to depreciate very much. Basically, if renminbi depreciate over 7.50, I think there will be quite an amount of capital outflow. It will add fiscal financial instability to the economy. So if this is the case, I think China's response will be very passively. For Chinese enterprises, I think the response can be different, because we heard a lot of news that Chinese factories have a plan to build the plants in the US to avoid tariffs. So this has been seen in the past several years. I expect the micro enterprises level, friend shoring or reshoring to the US could be a best option.
Zhaopeng Xing there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, December the 9th. Catch you tomorrow with a deeper preview of the Reserve Bank of Australia's first rates decision of the year. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.